baseball. It's unbelievable.
It's a boring sport anyway. Welcome to the Real Estate Addicts podcast. We're here with your hosts, Mark Savatsky, Choose Boston.
Ray Hurto, RH Investment Group.
Dan Rubin, RH Investment Group.
Awesome. And before we get into it, I wanted to thank you guys again for supporting the podcast, for listening. It would mean the world to us if you could subscribe to our YouTube channel and share that with friends. We're getting a ton of listens through Spotify and Apple Podcasts, but Dan wants to be a YouTube influencer once again.
He's grown to 100,000, he says.
So this is our
let's get show us some. I'd like to get to 100 first.
So
and then 100 exit.
Yeah.
1,000 exit. Yeah.
But what are we talking about today? Metrics, right?
Metrics, yeah. So metrics as in like shortcuts, ways to quickly evaluate the health of a deal. When I was first transitioning from construction to real estate development, this guy smirks at me when I say transitioning. Sorry.
Only you think I'm smirking. I didn't even think of that. I'm thinking of metrics in my head. Oh, God, what are you talking
know what you're thinking.
I'm thinking 2% rule. Now I'm thinking 2%.
How about Christy Noem's husband? Did you guys see that news?
No.
Oh, yeah. She's like the Homeland Security woman.
Well, she was.
And she's super
now she's gone.
Right-wing, and her husband wears her shoes at night. And isn't just...
Did that just come out?
I don't want to kink shame anyone, but yeah.
Is this like the Ayatollah's son being, a little different?
Are you walking around in Jesse's shoes?
I just think it's funny with like these like hard right people who just ate themselves. Right? Like that, like...
And unnecessarily angry. Yes.
Are you walking around in Jesse's shoes at night?
What? I'm not, but maybe. I don't know. We'll see how I feel tonight.
Can you tell us about those socks?
Socks. Did you always want to go into that?
Did you want to talk about your socks?
Yeah, so I posted something on LinkedIn about the automatic folding laundry machine, which turned out to be a scam. In the comments, someone wrote like, saving time on that is awesome. What I've done is replaced all of my socks with one type so that when I'm folding my laundry, I don't need to pair up all these different orphans. And I was like, that's a great idea. So I threw away all 30 of my individual pairs of socks and I bought 30 pairs of socks from overseas. And one by one, every single day I wear them, they rip at the same spot on the big toe. So
you're walking like a weirdo.
I don't have any of my own socks.
Or these are really bad socks.
Yeah. And these socks are just falling apart.
So you're just throwing away socks every day?
Every single day, yeah. I need to figure out a solution because I'm running low.
Well, that would be a very bad ROI. So why don't we talk about some numbers?
There
What do you want to do?
Good transition.
That's a good transition.
Yeah, good transition. Construction to real estate development, I took a course at BU called Fundamentals of Real Estate Finance. And it was an excellent course. I took a number. This was the one that stands out. And really what it focused on was all of the different alphabet soup of abbreviations. DCSR, cap rates. DSCR. Sorry.
You already failed.
Well, NOI, right? Yeah. That's a big one. Net operating income. EBITDA, yeah. Well,
that's more for business related.
Yeah, that's if you're doing, a lot of public companies, Warren Buffett and Charlie Munger are among the most well-known and well-respected.
Well, let's start with our favorites,
investors.
right?
And they hate when it's complex and unnecessarily. It's almost like you're making it sound more complicated than it is. And I feel that way about a lot of the metrics in real estate.
Well, I feel that you can do 80% of your underwriting on a napkin on one tab of an Excel spreadsheet. Yeah. The marginal benefit to the second and third tab on that spreadsheet is 10%, 5% more accurate. This is our next guest here. I'm going to answer it.
Hey, it wouldn't be an episode if we didn't have Mark's phone going off. Once per episode. There he is.
I'll be right out.
Excellent. Well, look at this, guys. Live phone answer.
We
should do a live episode where we take
Should
calls.
We stop this and redo this episode?
Well, no.
We'll we keep going?
We're going to keep going. Let's roll.
What's your favorite?
My favorite metric? Well, the first thing I want to say is that any numbers...
You going out in your socks? Okay.
This episode, for those watching, this thing's off the hinges. For those listening, I don't even know how you can listen to this, but we'll get it going. We're all having fun here. Dan, since it's just you and me now, and we talk every single day, you know how I feel about the numbers, but you can make a spreadsheet as complicated as you want. You can make it as simple as you want. You can put any numbers into it that you want. Yeah. And the spreadsheet can look great, but it's got to be based on reality. And that's my biggest problem with underwriting and numbers and metrics is that people will put the feel good numbers on there, which makes them feel like it's a deal, but it's got to be realistic. Don't say like, oh, well, we're going to build this and in 2 years, comps will be higher and these are going to be the numbers that we achieve. Well, what if they're not? You got to have that range.
People love to inflate their numbers.
Yeah, we all lie to ourselves.
Yeah. And one thing I did
because we fall in love with deals.
Right.
Yeah.
The two most important things you're going to have are you need to have sort of like a variance matrix. And I've done one of these for us on our underwriter. And it's different cells. And on the row side, it's like, sellout price if it's a project, right?
Best
Do we go
scenario.
plus, and it's like you can control the percentages for each thing. You can go up by a percent each cube or 2% or 5%. And then on the column side, it's construction costs. So what if we save money, which do you ever? But let's say you do. Or if you go over, like how does that screw up your numbers? So you kind of have to look at it. And some people call that sort of sensitivity analysis. And I look at it two different ways when looking at a project. A little harder to do when looking at it from sort of a rental perspective, because you may have to take into account the time value of money when you've got investors and when you might be able to refi. So that gets a little more complicated. And frankly, it's a nut that I haven't really had to crack yet.
Did you answer my question about your favorite metric?
My favorite metric?
Or at least favorite. I'll take
if I'm doing back of the napkin, my favorite metric is the 1% rule, which means if
that's on a rental play.
Okay.
Right. And on a rental, I'm looking at 1% of say the property's being sold for $1 million. Ideally, I want that property bringing in $10,000 gross. Very hard to find in Boston. You get a property that's $10,000 gross, they're probably asking 1.5 for it. So you're already less than the 1% rule. And on bigger pockets, they typically talk about the 2% rule. So you double that.
Wow.
That's how high the values are here in the Boston area. I'm sure other areas like that.
Talk to me about the shortfalls or cap rates, because that's, I think, the most common.
Cap rate, yep.
Yeah.
Just a number. It's really, it's sort of meaningless, but it's sort of a way to describe the value of properties relative to their net operating income, which is the gross minus the operating expenses.
A lot of commercial brokers and agents will use a cap rate when determining the value of a
give me round
property.
Numbers ending in zero.
So 5%. 5% might be a cap rate.
Calculate a cap rate. And then tell me like what a realistic target is for an acquisition.
It depends on your market.
I know.
You don't.
Well, let's not use Back Bay and let's not use Western Massachusetts. Give me like something down the middle.
6% cap rate, 5% cap rate. Back in the low interest rate days, it was 4% cap rate.
But how do you get there?
Well, you get there by seeing what the market will pay for a property, and you divide it.
There you go.
And you divide it by, so you take what the market would pay in theory for the property, and you divide it by your net operating income, and that's it.
What is your net operating income?
I just said it's gross minus operating expenses, gross income.
So it's what you're left with?
It's what you're left with before your debt service, before any of that below the line bullshit like depreciation.
You take all your income, you subtract all of your expenses, and that's your NOI.
Actual expenses, not the paper expenses like depreciation and all that stuff.
Your actual hard expenses, and that's your NOI, and not including your debt service. So not including your loan payments or anything like that.
$100 for a property, and the NOI on it was $20. What is your cap rate?
Like 50%. I don't know. What is that? That's a very high number.
Mark's just making shit up.
I was going to say, if you take $1 million and your NOI is 50 grand, you're looking at 20. Maybe I'm doing the math wrong here.
That's a 20 cap?
No, I think we're going to go off the rails real quick. I think I do it. You do it the opposite. You take the NOI and divide it by the value. That's it.
And 5%. A general rule of thumb is the lower.
We got this.
No. I do this all the time. I'm dyslexic.
If you want to equate cap rate to like cash on cash return or cash flow, typically the lower the cap rate, the less cash flow you're going to have. And the higher the cap rate, the more cash flow you're going to have.
It's generally a measure of risk, and it's relative to other properties in your market. And it's also going to have some interplay with what the actual debt rates are. Because if I can go out or savings rates.
Cap rate does not have anything to do with your cost of capital, your debt service.
It will in some regards. You're not going to have a cap rate that's going to be higher than your debt potentially. Well, it depends on what kind. Okay, you know what? You're right. If you find a diamond in the rough, you're going to get a great deal, and you can do it. I think cap rate to me means nothing.
The thing that cap rate means to me is a quick way to put properties side by side by side by side, and just it's a mental shortcut, but it doesn't mean that much more. What means a lot to me is cash on cash. So cash on cash is an evaluation of what it sounds like, how much I'm pulling out of my own wallet, and what the return on those dollars are.
And then what happens when you refinance and get all the money back?
$0 of their own cash.
Yeah.
I think that's infinity, right?
It is infinity.
Yeah. So that's a very...
Or you pull money out of the deal and now it's like, what is it? Negative infinity?
I just broke the calculator.
So I don't know. That's not how I would evaluate a deal. Some people will look for a dollar amount per door. They won't look at cap rate. Some people will say,
I think that's one of the biggest issues. There's no real common denominator in terms of what someone looks for and qualifies it as a good deal, right? So, like to you, cash on cash is important to you. Cap rate might be important to someone else. IRRs might be important. Internal rate of return might be important to someone else.
A lot of investors.
There's a lot of different metrics that are important to certain people. And so when you're going out and you're either looking to raise money or you're looking at evaluating a deal, you have to come up with what metric is the most important to you.
Right. A great example where IRR might be way more important than cap rate or any other measure of return on sort of a rental side is you buy it, you rent it, you don't care what you're making because you know in 5 years you're going to sell it or you're going to alter that property or do some other value add activity and make a ton at the very end, the terminal value. And then when you take that return and you annualize it, that's where your IRR comes from. So you don't get somebody says, oh, I want 17% IRR. You're not getting 17% every year. You may get nothing. And then in year 5, you get a big chunk of cash when that event happens.
Right.
So it's hard to say like what's good and what's not. And again, to Dan's point, it's very local to the markets. You know, somebody in like South Carolina renting out single families is going to have a very different view of what success looks like and a good return is compared to multifamily.
On a for sale development, what metric do you typically look for?
I'm going to take my total development costs and I'm going to compare total development costs being a combination of your hard costs and all of your soft costs. And I'm going to compare that to my total sell out and divide the two. So if a project makes, $100 and it cost me $90 to build, that's a 10% return, and that's marginal. You know, I want to make $20 on every 100.
But if you scale that to 100x, right?
Yeah.
You know, almost the bigger you get, the smaller that percentage needs to be. And the smaller you get, the bigger the percentage needs to be.
No, because I actually don't really concern myself. And I think that's a common mistake with absolute numbers. You can get very drawn into a deal by looking at absolute numbers like, geez, this thing makes $1 million. It's like, yeah, if it makes $1 million, but that's 9%, 7%, it's going to disappear. Like you need to stick to the percentage.
You might make $1 million, but it's going to cost you 20
projects
to do it.
Projects succeed and they fail on the margin.
Yeah, no, I get what you're saying. It has to have more meat on the bone, as we like to say.
Yeah, if your hard costs are $20 million, $1 million could go in a puff of smoke.
It's one change order.
Yeah. I mean, a lot of people see successful developers because the unsuccessful ones don't go out there and say like, hey, I didn't do a good job. So
they can live like vampires for a long time.
They can. And some do. We get it. But what I'm saying is that eventually they fail and we only villainize the successful people and no one sympathizes with the ones that put their necks out there, gave it an honest try and didn't do well. We'll exclude the group of nefarious participants.
I don't know. No one's ever felt bad for a real estate developer.
No, that's what I'm saying. No one ever feels bad ever.
Well, like I said, I think that's part of the reason that we do this podcast. I think is to humanize it a little bit and to show the back behind the glossy pictures and the big sellout numbers and what it really.
Hey, what are your thoughts on wealth tax?
All right, we'll talk about that on a future episode. This has been
any
awesome.
other metrics or no? We're done.
We're done. Thank you guys, as always, for tuning in here. Appreciate you listening.
Yeah, this was a chaotic one.
Thank
but we
you for
really
listening,
appreciate you.
rating, reviewing, subscribing.
See you on the next
one.
Okay, bye.